Welcome to Retirement Straight Talk with Paul and William, featuring award-winning financial advisor and former host of the Sunday Money Show, News Talk 1010, Paul Barreca, and his associate advisor, William Barreca. Creating and keeping wealth does not need to be complicated. Paul and William will cut through confusing and contradictory financial advice to give you the real facts to help you invest better and enjoy a worry-free retirement. The views and opinions expressed in this video may not necessarily reflect those of IPC Securities Corporation. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.
Hello and welcome, everyone. This is episode 50. Wow, 50 of these.
A milestone.
Of Retirement Straight Talk with Paul and William. And whether you're watching us on YouTube or listening on one of the streaming services, welcome. Today, we're going to talk about the subject that, honestly, I think a lot of people don't want to talk about, and that's taxes in the estate, how they occur, when they occur, different strategies that you can sometimes minimize. But one thing we got to let people know, and that is there are so many nuances. Every situation is different. You absolutely have to get professional help with experienced people before you do anything in writing with this stuff.
Otherwise, legal advice. Paul and I, we're not lawyers. So before you enact many of these strategies, make sure you get qualified legal advice.
Yeah. And the other thing, I find people don't want to talk about estate taxes because, well, for a couple people don't like to talk about death. And the other thing, people in their 40s, 50s, they got other things going on. They're raising a family, a business. Estate taxes, I'll worry about that later. But the problem that can happen is that down the road, you get in your 60s, maybe early 70s, and you go, oh, we got to think about estate taxes. Sometimes it's too late to be really effective. So I came up, we talked about this before, my favorite new tagline, plan now or pay later. And I think that's extremely accurate.
Yeah, very accurate. So today, Paul, I think we're going to talk about, some of the main assets that go into the estate, the tax implications of them in the estate. And then later on, we're going to talk about some common ways that people use to minimize taxation in the estate and the pros and cons of several of them.
Yeah, things like trust, joint ownership. And by the way, again, there's a lot of nuances there. So we're going to try and fill in some of the gaps there. Okay, so let's start off now. Some of the things that go into your estate. Well, it's a heck of a lot, isn't it, Will?
Well, Paul, should we talk about first some common misconceptions is that there's not like a real estate tax in Canada.
Bingo.
There's what's called probate. So when you pass away, your will goes through probate, your estate goes through probate. And what there's a 1.5% tax on the estates that go through probate. Mm-hmm. Now, we're going to get into a lot of these, but there are some ways to minimize probate or eliminate it on certain assets.
Yeah.
I think as we're going to see here, again, we live in Ontario, Paul. The probate on assets above $50,000 in the estate in Ontario is 1.5%.
I think they changed that to 1.5 from zero now. I believe they changed it, William.
Oh, I didn't see that. But in any case, It's 1.5% on most assets, if not all. So I think we've seen this with a bunch of our clients and people we meet with. People, for some reason, no one likes to pay taxes. Everything would like to be tax-free. But some of the things people do, the lengths people go to minimize or eliminate probate, on something that 1.5%, it's really not big of a deal in the grand scheme of things. I think we're going to see here some of the schemes people use to eliminate or minimize it, not always
create worse problems, can create worse problems.
Way worse. So sometimes it's just better to just accept you got to pay some probate and
pay the piper. One of the things you want to think about too, if you have an investment portfolio, the value of your portfolio or your real estate can go up and down 1.5% in one day.
Yeah.
You want to keep everything in perspective. So let's get going. What is included, William, in the estate that's subject to probate and so forth?
Well, some of the common assets, we can start off with the biggest asset for a great majority, probably of our listeners, is the principal residence.
Mm-hmm.
And how that works is if you're married and you own it, you can own it jointly with right of survivorship with your spouse. So then if the first spouse passes away, it passes on tax-free to the surviving spouse.
Yeah, that's the
Now,
spousal rollover. Yeah.
as the spousal rollover, correct. Now, if you're not married or if your spouse predeceases you and then you pass away, what happens to the principal residence is it's tax free in a way in your estate, and that you don't have to pay any taxable capital gains on it, assuming it's you have the principal residence exemption on it. And assuming, like most people, they pass it on to their kids, the kids will get it tax free, but they'll only have to pay taxes on it when they sell it. So most people do sell it, and they just have to pay taxable capital gains based upon the value.
Yeah, go on, Will.
Based upon on the value of when they sell it from when they took ownership of the property.
Yeah.
So there's not going to be some huge gain if their parents bought the house 50 years ago or whatever it is. So in most cases, it's somewhat minimal.
Yeah. So next thing, of course, is registered plans, your RSPs, RRIFs. Those go into your state. They're fully taxable. By the way,
savings accounts.
Well, tax-free savings account, yeah, we'll talk about that in a minute, but your RSPs and your RRIF, what a lot of people don't realize is that the estate is responsible for the tax, not the beneficiary. So if there's $100,000 in tax due on it, that comes out of the estate. So the money passes to the children, the named beneficiary. They don't have to pay the tax. It's the estate. So clarifying that one.
Yeah. So for RSPs and RRIFs, you want to make sure if you're married, it's somewhat similar to the principal residence, where you can name your spouse or common law partner a successor holder on your RSP or RRIF. So then if you pass away, then the RSP or RRIF passes tax-free to your surviving spouse. Now, if you don't have a spouse, or again, if your spouse has predeceased you, like we mentioned, the RSP or the RRIF, it goes through your estate and it's subject to probate.
Yeah. Now, TFSA is a little bit different because there's something, if you name, normally you'd send it to your spouse or a common law spouse. If you name your common law spouse or spouse beneficiary, okay, the money will transfer to them tax-free. However, now that money is taxable in their hands, future income and so forth is taxable. That's not good. What you want to do is have them designated as successor annuitant. Big difference. What that means is when your spouse or common law spouse is successor annuitant, the money can transfer into their TFSA tax-free, and then it will grow for the rest of their life tax-free. So big, big difference. TFSA is successor annuitant. And just one other thing too, the RRSP is not a trust. It just essentially goes, if there's money left over, it will go into the estate of the owner. So moving on, the next thing there, William, is
unrealized capital gains. And so those are subject, mainly what our listeners would probably be dealing with in these cases is either a joint investment account, a non-registered investment account, or a secondary property that's not labeled as your principal residence, whether a cottage, a vacation property, whatever the case is.
Investment property could be either of those.
Right. So how those work is, say you own an investment account. Similar to, again, a principal residence, you can name a spouse, you can name a joint with right of survivorship, and then if you pass away, it passes to your spouse tax-free. But if that's not the case, if it's just an individual non-registered account or your spouse has predeceased you, then what happens is there's all your assets are deemed to be disposed of on whenever you pass away, and then your estate has to pay the taxable capital gains taxes or the capital gains taxes on any realized dispositions in the estate. And it similarly works the same way for a vacation property. any unrealized gains are triggered in the estate, and the estate has to pay taxes on it.
Now, you can defer that sometimes using something called a capital gains reserve. Let's say, for example, you sell a business or a property, but you're going to be paid over several years. If you're going to be paid over, say, 5 years, you can charge the unrealized gain, pay tax on it over 5 years. So that's something people want to be aware of, but it's only in the situations where you're going to be paid for it over a number of years. So next thing, where are we on next here, William?
Why don't we move on to, do you think it's time to move on to some common ways? I think we've been over most of the common assets now. Do you want to move into some different ways or strategies people can use to minimize the effect of these taxes in their estate and the pros and cons of them?
Yeah. So first we could talk about, the RRSPs and the RRIFs. No real way to get away from that once the spousal rollover has happened. The taxes have to be paid. Now, some people can use permanent insurance to pay these taxes. Sometimes that can be a very effective use, but essentially, the taxes have to be paid. Not a lot you can do on that. Now, next thing, the TFSA we already talked about. TFSA is tax-free. If you leave it successor annuitant to your spouse or common law, tax-free in their account. When it goes to the beneficiary, tax-free. Hey, you can't get any better than that. Now, why don't we talk a little bit more about unrealized capital gains now?
Sure.
And I think we spoke a lot about real estate. Again, we're going to talk about joint tenancy and trust in a few minutes. Again, the spousal rollover to spouse or common law spouse.
Why don't we get into now, Paul, both for non-registered accounts and real estate, a common thing people do to try and avoid probate on those assets is just putting their adult children on as joint owners of those accounts or that property.
Oh, yeah.
Ever heard of a client wanting to do that?
Well, some people do it erroneously. For example, they'll say, "Oh, here's my principal residence. I want to leave it to my son's name too. I'm going to put him as joint owner." Sometimes that can create a bigger mess than it solves, because potentially now you've created a future capital gains tax that wasn't there before, because that other son or daughter. So we're going to talk about joint tenants and some of the problems and some of the benefits of it. And really, there's two types of jointly held assets. One is tenants in common, and the other is joint tenancy. And there's three different types of joint tenancy. But let's talk about tenants in common first. Now, this is, let's say you, generally not within a family, but can be, you own a property with two other investors. So you have unidentical ownership. Maybe one owner owns 50%. Maybe there's two other partners that own 25% each. No right of survivorship here. The ownership is dealt with in the will, and taxes are paid by the owner. So if one person who has 25% ownership passes away, that 25% ownership goes into their estate, and they pay tax on that 25%. So that's tenants in common. The next type, is what I think most people in a family situation really prefer, and that's joint tenants with gift of right of survivorship. What does that mean? Well, that means is you can transfer ownership to child, grandchild, whatever, but there's no disposition. So there's no tax on realized gain at that point. And the parent maintains complete control of the property, the investment account, the bank account, whatever it is. And they pay tax on any and all income moving forward until they pass away. When the parent passes away, tax on all the unrealized gains will be payable, and then the asset will flow to the joint owner. Now, this is really key. In order for this to work, you need proper documentation. You have to have some document. It doesn't have to be fancy, by the way, to indicate that this is what is wanted. Without that documentation, you can have problems. Now, the other big thing one of the problems with this is you want to be clear on equalization of your estate. Let's talk about this for a minute. Let's say you have more than two children. You want to put one child on as joint tenants with gift of right of survivorship. Well, did you want to leave all of that on your death to the one child, or did you want that split between your two children? More likely it's the latter. You have to very clearly outline that in your will. Otherwise, you're asking for problems in your estate. You're asking for a fight amongst your children. And
I'd suggest, Paul, whatever the type of joint ownership you're thinking about, I'd suggest in most cases, again, like we spoke about at the top, it's probably, I would suggest it's not worth it for most people just to avoid paying probate. If you talk to any estate lawyer, stuff like this is one of the biggest causes of estate conflict. You get kids fighting in the estate over what was the true intent, what happened here. And it can also cause tax issues where, again, if things aren't documented properly, the CRA can look back and say, oh, this was a deemed disposition. You owe taxes for all these years. So there can be a multitude of problems that arise from things like this.
Yeah, unless you set up the joint tenancy properly. Again, you could have a situation where you can lose control of the property. You don't want to be dependent on your child to say, can I sell this property? Can I get your permission? You don't want that.
And it can be subject to their spouses as well, which I think most parents don't want.
Well, that's it. The other thing too, it can be subject to the creditors of your children.
Mm-hmm.
Don't want that. Kids get into trouble. Hey, they go bankrupt. They get into financial difficulties. And again, they get divorced. Wow. You want to avoid those types of problems. Again, estate equalization is also important. You want to make sure you very clearly, if you go through with one of these strategies, that you very clearly indicate in your will, this is what you want. You want those assets to be split amongst your two children or whatever those wishes are. Okay. So, just one more quickly, there's something called a bear trust. We're not going to spend a lot of time on that. That's more if you have an asset and you have a partner or partners, and where the legal ownership is with the trust, but the beneficiaries maintain control over it. We're not going to spend a lot of time, more for business situations.
And again, just one of the there are some benefits to it, but one of the downsides now is yearly. It was supposed to start this year, but it's going to be in future years now. You're going to have to file a yearly trust return, tax return for any bear trust. So that's another more paperwork, more cost involved with that. Okay, so let's go into some other ways, some common strategies that people use to minimize estate taxes. One of them, a big one, is seg funds. Segregated funds, they're called. They're often touted as high value for passing probate. And just for our listeners, to quickly explain what they are, it's like an insurance contract wrapped in a mutual fund wrapper, essentially. So it's like similar to just buying an investment in an RRSP, a RRIF, a non-registered account. But instead of it just being a security, it's an insurance contract. And like we spoke about at the top of the show, an RSP, for example, or a non-registered account, probably a better example. In your estate, it's a deemed disposition. Your estate has to pay taxes on any unrealized capital gains. Now, a seg fund is different because, similar to like just buying any other insurance contract, you can name a beneficiary on a segregated fund. So in the estate, it passes directly to the beneficiary tax-free.
Outside the will.
Outside, that's right. Outside the will, doesn't go through probate. Sounds good so far, right, Paul?
Right. Just want to mention one thing before we go into some of the disadvantages, and that is a lot of people think because you say it's an insurance contract, people say, well, I don't want to buy insurance. It's not insurance. It's simply essentially a mutual fund offered by an insurance company.
Sure.
So with that being said, let's talk about some of the disadvantages. And a lot of people may be not aware of all of these.
Sure. So again, They're cracked up. I mean, one of the main benefits is, again, bypassing the estate doesn't have to go through probate. Sounds great. So you're saving, say, again, 1.5% on whatever the value of that asset is that you don't have to pay in the estate. But you pay for that. There's a reason you have to pay, like we say all the time, there's no free lunch in investing. A segregated fund can often cost, they're not cheap. They're very expensive. They can often cost over a percentage point more than just buying a similar investment outside of a segregated fund. So what in essence means is you're often paying more than 1% in fees every year for the life of that segregated fund just to save 1.5% at some point in the future.
Yeah,
Most cases,
great point. Great point.
yeah, in most cases doesn't make sense. Now there are some benefits of it. So again, I would say for most people, segregated funds just to save estate taxation does not make sense. Just because all the fees you're going to be paying over the years that you own it's probably going to amount to more than the estate taxation savings. But there are some benefits in that we discussed that it bypasses the estate, bypasses probate, goes directly to the beneficiary. So if a goal of yours is simply just ease of the estate for the executor, or you want to get your beneficiaries their money quickly, like a will or an estate can take months, if not years, to get settled. Where with a segregated fund, the beneficiary will have their money fairly shortly, even sometimes within a few weeks. So if you're looking at it just from a spreadsheet and maximizing the after-tax value of the estate, probably doesn't make sense. But if a goal of yours is just ease of estate execution, then it can make sense.
Now, one other disadvantage of the seg funds is that you're restricting yourself in terms of the number of investments that you have available. If you put your money with an insurance company, you get to choose between their segregated funds. They might have 2, 3 dozen, 4 dozen, whatever, versus the outside world. I don't know how many, almost tens of thousands of different investments are available. So that's something that I would consider a detriment.
Good point. I mean, our listeners know we're big fans of passive index investing. That hasn't really caught on in the segregated fund world. It's still mostly active, again, more expensive mutual funds.
And moving on to the last aspect here, which in estate planning from a tax perspective is permanent insurance. Now, a lot of people, they say, oh, I don't want any insurance. Well, if you don't want insurance, if it's beneficial to you or your estate, you still don't want it. And again, this is something that you really need proper advice on. Permanent insurance can be a great estate tool in certain circumstances and not a great one in others. Wealthy people often buy very big insurance policies because they know there's tax benefits for them. It's often considered the cheapest way to pay for the estate cost. If you have to pay $1 of tax in your estate, simple way to do it is what's the cheapest way of doing it? And oftentimes, again, we're not going to get into detail here because this isn't the right forum, but this can be used as the most tax efficient way to provide tax-free dollars without probate or tax at death to pay the taxes that need to be paid. Again, that's a subject for another podcast, I think, William.
Yeah, I mean, for our listeners, permanent insurance gets oversold, in my opinion, in the industry to a lot of people that don't need it. But like you said, for the right person, the right situation, it can work very well. It gets paid out tax-free to the estate. So you have to look at things such as your time horizon, your investment risk tolerance, and your personal situation to see if it makes sense for you. Don't do it in almost all circumstances unless your TFSAs and RSPs are maxed out already. But then once that happens, it can make sense as an alternative to non-registered investing. And another case where it can make a lot of sense, I think in more circumstances, is when there's a need for cash in the estate, like to pay for capital gains taxes if you really want to pass on a cottage to the next generation. Oftentimes the next generation can't afford those taxes, so insurance can be a great way to pay those taxes in the estate.
And some of the problems that the insurance can avoid is people say, well, I'll just pay the taxes out of, sell some investments, sell the cottage. But what if you're in a situation where the market's in a downturn? What if you're in a situation where the market for securities or the cottage is in a downturn, or maybe it's like it has been in the last few years where the value has gone down maybe 10, 20%. Well, now you spent an entire life to build up that asset. And you know what? When the kids want the money, they say, give me the money now. They generally don't want to wait. So your potential to sell at a discount. The other thing you want to be aware of where insurance can be massively beneficial is if it's owned corporately.
Yeah.
Again, subject of another discussion, you can use something called the CD or capital dividend account. Essentially eliminates the one entire level of taxation. You're able to draw money out of the company in a very tax efficient manner. Huge, huge benefit if you're in a corporation. So just quickly, we went through a lot of stuff today, William, and I'm guessing there's a few people, their heads are spinning around. That's why you need a professional, honest advice on this stuff, because virtually everyone's situation is different, and usually the best solution is also different. Even for families in exactly the same financial situation, their solutions may be very, very different.
Absolutely.
So I think that's a good time to wrap it up. Our next podcast, something we're gonna talk to the business owner, and we're gonna feature a guest this time. Guest is Dennis Sayre. Dennis is president of Sayre Financial. We've worked with Dennis, or I've worked with Dennis for a decade and a half or so, and he focuses on business owners. And we're gonna talk about the use of one of the biggest potential tax saving strategies for the business owner. It's something called the family trust. Very interesting topic. If you are a business owner, you absolutely do not want to miss this next episode.
Awesome. Well, thanks everyone. Thanks for everyone, by the way, who's been around for the full ride for 50 episodes now. Who would have thought we'd get here, right, Paul?
Oh, well, hey, we just won't shut up, I guess.
I guess not. So I look forward to another 50 more. Can't wait for 100th episode. Again, thanks everyone for listening along. If you like what you heard, want to follow along for more of our insights, make sure you subscribe, by the way, whether it's on Apple, Spotify, YouTube, so you don't miss an episode. You can also find us on our social pages. I'm on LinkedIn and X. Paul's on LinkedIn, so follow us along there. We're both fairly active on there. So thanks everyone. Thanks, Paul, and we'll chat in a couple of weeks.
See everyone next time.
This podcast was brought to you by West End Wealth Planning, an award-winning wealth planning practice catering to small and medium-sized business owners and to those looking to create a worry-free retirement for themselves and their families. To learn more, go to westendwealth.com. Don't forget to rate this podcast and subscribe to Retirement Straight Talk with Paul and William by going to Apple Podcasts, Spotify, or wherever you find your podcasts.